Started. My name is Michelle Rapp from the Office of Alumni Relations, and I'm really excited to have all of us here tonight talking about this big topic of FinTech. And more importantly, we have three great speakers here that come from unique and diverse perspectives. And this is going to be an interactive session too. So I'm going to have them introduce themselves, but we're really going to, feel free to turn your camera on and ask questions when we create time for that. We really want it to be a discussion and dialogue. So our speakers tonight are Mike Almeraris, Greta Meszoely, and Doug Lowenstein. So I'm going to turn it over to Mike to get us started.
Awesome. Thank you, Michelle. So my name is Mike Almeraris. I was a Northeastern alumni from 2005 from the School of Business. So very excited to be back here talking tonight. I live out in California, so it's daylight for me, although I know in Boston it's not as warm and definitely not as sunny as it is out here. I'm over in the Bay Area. I currently work at Banco Santander, which is actually our Americas headquarters is out of Boston, but we are a global bank where I am GMing, general managing our API marketplace, while also running our developer, partner, and content ecosystem. So a little bit of dual hats. And my background is in technology. I was at Google for about 8 years, HTC, the smartphone maker, for a number of years. And then way back when, was at UBS Investment Bank in sales and trading and technology back in the day there. So happy to be here, happy to discuss FinTech and how I got here and the importance of it, and happy to have a conversation tonight. Thank you, Michelle.
Great, let's pass it to Greta.
Hi there, everybody, and it's great to be here. Thank you, Michelle, for the introduction, and it's great to see so many people log on. I am a 3-time alumni and former faculty, actually, at Northeastern, and then I spent some time, one from the business school, and then obviously coming from a cross-disciplinary background, which is what I bring to sort of FinTech, and in addition to a strategy background. So I come to FinTech as first an advisor, first working with financial firms, so from a consulting standpoint, and also a strategy professor working across that area, and that becoming a strong interest. And then following my career as a professor and taking off in that space, I found myself working increasingly looking to solve problems in the banking system or financial institutions. And so then ended up bringing together a team of technologists and researchers and executives from one of the organizations that I was working for, and starting a FinTech company, a big data company, basically leveraging technology to solve problems within the financial world. Since then, I have done a lot of work, and my focus has been a lot of sort of democratizing finance. And so so that's sort of where my interests are in applying FinTech. I'm also, I think in my bio and many of you in this session can appreciate that I am working with the broader Northeastern community in developing sort of this FinTech ecosystem as well, and on the FinTech steering committee in the business school. And so now I'm turning around another number of companies and doing some other things as well, but that's my FinTech background.
Great. And Doug.
Hi, everybody. It's great to once again see a lot of faces and just the ongoing interest in FinTech at Northeastern. Just real quick on my background, I've spent more or less my entire career in FinTech. I think even predating it being called FinTech, going back about 25 years or so. And I've seen FinTech from a number of different dimensions. I've seen it from the corporate side, where I worked at Capital One for about 11 and a half years as a senior strategy executive, also with kind of a strategy background, and worked in many different areas of growing Capital One beyond its core credit card business. And not everyone may be as familiar, but Capital One is a very technology and analytics driven business, and was really one of the earlier disruptors of financial services in that role. I've also seen fintech from the investor side. I worked for a venture capital firm, my first job out of college, and then also we created a fintech fund while Capital One back in 1999, and played a role investing in a number of companies and participating on the board of several fintechs. One in the auto finance space in particular that was very successful, went on to go public and later be acquired for about $4 billion. And then more recently, over the last decade or so, I've seen it from the startups perspective, working to build startups in the fintech world, with the common theme being helping people alleviate their student loan debt problem, something that might be relatable to many folks today. First was a bank product and a rewards program that helped pay down your student loans. And then my more recent startup, where I was the second employee, we invented a new employee benefit where employers help contribute to pay down the student loans of their employees. So, have certainly seen how fintech's evolved over the years, and we can certainly get into that. My connection to Northeastern, while I'm not a Northeastern alum or a triple, as Greta said, I have a daughter who is a current student at Northeastern, who's a sophomore, as well as have been working for the last 10 months or so for folks within DeMoore McKim, and then also from the kind of lifelong learning part of Northeastern, to build a fintech cohesive educational program designed for both students and also for professionals. And so I've been spending a lot of time, like others, on the fintech steering committee, but more generally speaking at Northeastern. But pretty excited about the concept that we've developed and hope to get launched later in this year.
Wonderful, thank you. So I want to ask all of you, how do you even define what fintech is? And what do you want to draw attention to about it? Maybe I'll go in the reverse direction and start off with Doug.
Okay, sure. I think fintech, it's a very broad term. I mean, when you think about what fintech includes, if you break it up literally into financial services and technology, the way I tend to define fintech is basically the use of technology to drive innovation and disruption in financial services industries. And I further define financial services industries, to be essentially broken into things like banking, which is huge when you include the deposits and loans, investments, insurance, and payments, each one of which of those four things are massively complex markets. So when you think about the way that the innovation has occurred, or technology, or even just changes in consumer behavior have impacted those complicated markets, it creates a really broad playground for a lot of opportunity to create a lot of impact. So I'll leave it there and turn to my colleagues here.
Greta.
No worries. So I am completely on the space with, I think of an important part. I follow on to Doug, and excuse my, sort of jumbling. I'd like to follow on to Doug because I think that encompasses much of my perspective. And oftentimes I think we look at fintech as being, you have to be a technologist coming to, and then you build on some sort of financial, which products or services or solving a problem that way, which is extremely important. But I think what is really unique about fintech is that it requires multidisciplinary approaches, not only approaches, but also capabilities and perspectives. And I think, it's in my mind, it's using technology to solve problems that involve finance. So it could be, some sort of in addition to payment systems or and insurance. There's so many broad markets in terms of even democratizing finance and so on. So I think the important part is that you're using technology to solve problems, and however you come to it, you can facilitate those that multidimensional scope of capabilities to get it done, and needs and consumer, from a consumer driven perspective, and then also within firms to solve problems, being able to reach and effectively provide products to make money move, or to relieve some sort of tension in the system, or that kind of thing. So I think the really important part is that it's very broad, and that I come from a strategy background, as does Doug, and also from a problem solving innovation perspective, or from background, that it's getting it done. And I think that's an important part. And if you can bring technology to it, your partners or whoever, wherever you are, have to have some other capabilities to really move it and address issues in the marketplace.
So I agree 100% with Greta and Doug. The only difference I would make is I would simplify. I look at fintech as not even an industry. I would actually look at it as just an innovation. And it's just an innovation in enhancing and automating the delivery of financial services. So when we talk about fintech, to me, it's just about the innovation that's actually automating and enhancing the work and the world of financial services, and disrupting it to be faster, more usable, more transparent to the end consumer overall. So I would just simplify. The other thing I would do is Doug named a lot of different areas of fintech. Two areas that I think he did not name that I'm just going to call out in addition to everything he said is reg tech, which I think is a really important one that is vastly overlooked because it's not as sexy and not as interesting, because you're talking about AML or anti-money laundering at that point. You're talking about financial directives, terrorist financial regulations. So a lot managing compliance in those senses. And the other one I would call out is blockchain and crypto. And again, blockchain and crypto, obviously very talk of the town right now, super sexy, but they are also forms of fintech. Again, that innovation in changing how financial services are working today. So that would be my only adds to everything that Greta and Doug already mentioned.
I wanted to see if the three of you might like to give either something that you're particularly passionate about, but working on, or even an example of something that you're engaged with right now that might give people some insight into some real world happenings. Whoever wants to jump in.
I was going to say, Greta or Doug, do you want to kick us off, or I'm happy to? It's up to you guys.
Go for it, Mike.
Go ahead.
Yeah, totally. So I think one interesting trend that we're seeing, and again, I'm coming from a bank, and if we think about banks in 30 years ago, a bank is where you did all of your financial services. You would create your account as a consumer, you would transfer money, you would make payments, you would buy your house and get your mortgage APR through a bank, you would get your auto loan through a bank. It would all happen in that. You would manage your budget in a bank. What we have seen over the last 20 years with the proliferation of mobile applications is this trend toward unbundling. And again, if you are a bank, you make most of your money off transaction of these services, right? The transaction volume of the services provided. And so when you start to unbundle a lot of those products and services from a bank, it puts these large scale institutions a little bit at risk, because we lose transaction volume, and with that, the transaction fees that go along with that. And so what we have seen is the huge growth, and I'm sure everyone on here, I'm not going to ask for a range of hands, but I'm sure most of you are either Venmo users or cash users at this point. And that's how you're sending each other P2P, utilizing P2P social apps. That is how you're sending money today. You could think about Mint as your PFM or your personal financial manager. and you're not necessarily using the budget that Bank of America or whomever is providing you in their actual website. So you're seeing a lot of that unbundling happening. And so one of the big trends is moving toward digital wallets. And so digital wallets are really interesting because, again, instead of having, especially if you're a gig economy worker, instead of having your gig economy employer, Uber, Instacart, doesn't matter, enter in gig economy company here, instead of having them pay a bank account, they can pay what is called a digital wallet. And then you can use that digital wallet capability to make payments, to buy to go to merchant sites and make purchases, to do whatever you want from it. So it's completely taking your money away from banks in general. And so this has become a really hot topic and a huge move that we are seeing. And so actually a lot of these digital wallet capabilities are brought, and most consumers don't know this, are actually brought to you by the banks because we have the piping for it. So a lot of the trends that I've been working on are how can we supply a lot of that infrastructure to applications like Uber or Lyft. And a good example is Lyft Direct. So when Lyft decides, yes, you don't even need a bank account, I'm just going to pay you in a Lyft Direct debit card that's brought to you by MasterCard, and you can go make any purchases you want. Actually, the back-end plumbing of that is brought to you by a bank, and it's done through APIs. And so just another way as we think about this trend toward unbundling of services brought to you by a bank, and you personally thinking, I don't need a bank. I can now do these things with digital wallet capabilities, which give me the card and allow me to cash out at thousands of ATMs or allow me to make purchases. It's actually still being brought to you by a bank. And so at the end of the day, you're still a bank customer. You just don't know it in some ways. So for me, that's been very, very interesting to get the opportunity to work on and to continue to see those businesses grow, which again, gives another form of revenue back to banks while keeping us within the supply chain of how that end user is making transactions. So that's just one way fintech stays relevant. I'm going to pass it over to Greta or Doug.
Yeah, I can jump in, Mike. Those are great examples, and coming from banking can certainly relate to everything you said. In fact, maybe I'll kind of build on that a little bit with something, perspective that I certainly share often, and then even give an example with what we did at Gratify, and that is that a lot of people associate fintech with startups, and there are, of course, lots and lots of very successful fintech startups and unicorns, as they're called. I'm sure people are familiar with companies like SoFi and other large players in that space. But because financial services is a highly regulated set of industries, kind of back to Mike's RegTech point earlier on, it is a very gray and blurry world between startups and incumbents. And in order to succeed in the long run, even startups need to essentially take on a lot of the traits of incumbents, or often will wind up partnering with incumbents in order to do so. So that kind of brought to you by a bank kind of comment is happening kind of all over the place. And it plays itself out, whether it's in investments or insurance or in some of the other industries as well. And in order to really succeed, you have to understand how the old world kind of industries actually work and how they're regulated. I've seen many startups in fintech. There's a lot of enthusiasm and they see a very broken process and to try and fix that process, but often come in somewhat naive to some of the constraints that are part of this industry and overlook incorporating that into the sort of innovation in the early stages, and it leads to problems later on. Sometimes it's not necessarily regulatory. Sometimes it could be, a risk management issue, where a problem is being solved, an idea is created around a product that works in the current environment, but because financial services operate in a broader economy that is constantly shifting, going up and down in different interest rate environments, to build a sure-footed, long-lasting, successful company, you need to be able to essentially come up with business models that are not just successful in the here and now, but also can last. I guess the point of it all is that it's a big blurry world, and kind of, I think Greta said earlier, it's a multidisciplinary space. There are consumer behavior and broken sort of ecosystems ripe for disruption, but there are a lot of exogenous influencers and forces that need to be incorporated, all kind of then using technology as an enabler. And so that's something I think that's really important. I'll hold on to the Gratify example for maybe later, because I think that kind of makes kind of the point at this stage.
Yeah, and I think one of the projects that how I even came into all of this was that there's so much within financial firms that is not leveraged for themselves, or that it's hard to share information, it's hard to, and then send that off to consumers to make better decisions and be able to leverage the system more effectively, and that everybody has the same information, or everybody has the same access to be able to manipulate data and so on and so forth. So we came to it with just literally trying to solve a problem, but then also allowing decision makers within a firm, and then creating those same platforms for people outside. So your average consumer has the same data, because it's not necessarily within, when you think of reg tech, there's so much that they can't release from a firm, because financial industry is so highly regulated that it's hard to be able to basically allow people outside. So the playing field is never fair. So a lot of what we were trying to do was create a system where we could leverage data and then make it available without compromising the regulatory environment and the requirements of a firm. So that was sort of one of the ways we did it, and basically with big data tech and platforms to do that. Another thing that we worked on, and that was from a technology standpoint and capabilities that we had, was just validating transactions beyond just exchanging money, but also just validating transactions in a location. So there was, sort of like a really consumer end, and then sort of coming from inside a financial firm to bring the same knowledge outside.
It's really helpful to hear some of the specifics, from the different angles in which you all work. We want to open this up to questions, and I definitely invite you, if you feel comfortable, to put your camera on. I'd prefer not to do it through the chat and have you ask the question. Why don't we use from the reactions tab, you can raise your hand, and let's see where we go. Who would like to start us? Oh, we've got a lot of people. I see Paige, so I'm going to go with Paige to start.
Okay, sure. Can you guys hear me?
Yeah.
Okay, thank you. I've had some technical issues in the past, so I always start with that. First of all, thank you guys for joining us. This is awesome already. So my question is around, so I'm about 6 years post undergrad, and I'm currently in Northeastern's Master's in Business Analytics program. And prior to that, I was working in financial services consulting in New York. So a lot of my clients are on like the larger institutional side. And when we think about, the hot term of fintech, and it was interesting hearing you guys kind of define that, I think it's been very attractive. There's a lot of, there's a healthy budget, I would say, but I would think of kind of in the product design and development and innovative space, sometimes there can be a lot of red tape and slower things, like a lot of these firms are just grabbing onto agile development, things like that. And so you can feel like it's behind more of a startup or maybe a smaller firm. So I'm curious to learn how you guys feel the space, like, can you find opportunities for that within those larger firms, or maybe somewhere, is it worth it in your career, maybe around my point where you're a couple of years in to maybe try that? And if you guys have any recommendations and kind of some of the pros and cons of smaller versus larger firms.
So Greta and Doug, if you don't mind, Paige is after my own heart here. What Paige is actually referring to is digital transformation. just to put it into 2 words. And what you're actually asking is, can stodgy old companies, behemoths, actually move and compete with startups in a space? And there are 2 reasons why they couldn't. The first is, hey, they're regulated, and this is a highly regulated industry, and startups are not necessarily regulated like banks and other institutions that have been around for a while. And the second is the culture of development. And the culture of development is, how do we actually do development? Is it waterfall or is it agile? And what do we actually call, even if we believe it's agile, does it actually look like waterfall? I say that because when I first started at Santander a little over 2 years ago, coming from heavily focused tech companies in product roles, I was told, oh, we're agile. We have agile coaches. We have scrum teams. This is what our roadmap looks like. And it was exactly what you would expect. It literally was a waterfall slide in front of me. And I was like, and by the way, you didn't start the next sprint until you completed this sprint. You reviewed everything, and then you made decisions on what would go into the next sprint, which is absolutely not agile in any way. So I give that to you just so you have context. So you're asking, could you still be successful? It was your first piece of that question. Can large behemoths actually change direction and still be able to compete successfully? So the answer is yes. I think there's a space for both. I think what startups can do is move very, very quickly and prove product market fit. They could prove there's actually a need for this product and there's demand in the market. And I think you've seen that with companies like Affirm. And I'm sure a lot of folks are familiar with Affirm. They're a buy now, pay later firm. And what's great is they moved a lot faster than banks, right? Or anybody else who's looking to give credit and increase the amount of credit they give. But everyone's always worried about risk. And anytime you loan out to a new customer, there is risk associated with that. So a way around that is you get these startups that aren't regulated or aren't necessarily looking at risk and have come up with new models of evaluating old customers, if you will. And so they actually proved that younger millennials don't want credit cards in a lot of ways, and they're afraid of credit cards. But if you mask that you may still end up paying the same credit card APR fee, you just don't know it, and it feels like 0% down, 0% a month, then that's great. And you'll go down that space all the time. And so you've seen massive growth from Affirm, from Klarna, and from a lot of the companies alike. But what I think you have then seen is this trend toward larger institutions recognizing they can do and employ the same kind of models that are pricing and taking a lot of these consumer loans, and they can actually offer it and they can bundle it and package together. So I think what's great is you have an opportunity for both to coexist, because I do believe startups can take more risk. And so they can go lower on credit scores and they can create what's called financial inclusivity for folks that may not have had an opportunity to actually get credit, which is awesome. But then you have the larger scale behemoths that can actually follow these models, be able to develop against them and lower their own standards. And for a lot of folks, they may choose to go with the larger company as a way of packaging or bundling with some other product or service to make it cheaper or to reduce their own personal risk or their own personal account openings across the board. So I do think there's an opportunity for both. I don't think it's going to be a one or another, but I do think startups usually, and what we've seen is startups do lead the trend as far as being able to take more risk, develop faster, and they have less regulation on them. And so they can move quicker. But I also clarify that with, I think you will see markets like the UK, and I work out of global markets here. And I do think you will see markets like the UK move toward regulating startups just as they do everybody else. And I think that will slow down the speed of innovation, but it'll also make it a little bit more of a level playing field. So I think that will happen. As far as your individual question for yourself, Paige, I think it's, what do you want to do? So I run into this all the time. I worked at tech companies that move at the speed of light. I'm now in a company that moves at a snail's pace, even though they think it's very fast. And it's just, what do you want to be the digital transformation person in a company who believes in tech and is doing a lot of education and is moving people along, and you get to see real impact? And obviously from a large scale company, there's lots more impact you can have. Or do you want to be at a company that's a lot more nimble and fast, and you'll see impact quicker, but just not as to the degree? So I think it's up to you. And then you kind of decide which way you want to go, but I think there's pros and cons to all. That was me talking for 4 solid minutes, so I want to make sure Greta and Doug jump in.
Yeah, I'll just add a couple quick things. Very much agree with all that Mike shared there. I guess I would say just a couple other thoughts. It is a continuum, of course, right? There are, on the larger company side, there are a lot of examples of companies who have cultures of innovation and are committed to technology and have made, sort of a big transition. Visa and MasterCard, alone spend, a lot of energy focused on innovation and invest and acquire startups and fintechs, quite frequently. Capital One, because I'm personally familiar with it, is also, I think, one of the more innovative thinkers and kind of adopters relative to old school banks, that exist out there, which Santander is probably kind of in that category. And there are many companies that have tried hybrid models. You see companies like Goldman Sachs, create a new brand around Marcus and put new resources and allow those to act more like a startup with more freedom and not a lot of the legacy technology and all the other stuff that comes with working for a large institution. There were a wave of incubators for a while there that have tried to do that as well. So I think the answer is, I don't think there's a right or wrong answer. I think at the end of the day, you want to learn how to be innovative, learn how to leverage technology, learn how to be nimble, but also become deeply grounded in the realities of those industries. So even if you were to go work in a startup, I'd argue, you want to be at a startup with that has people with experience from the industry. And that's the real combination that I think leads to the most successful, track record over the long run.
Yeah, and I'll just add on to that. I mean, I always worked with senior executives. And so we started from the top trying to build, platforms to solve a problem, or, organizing and bringing in these multidisciplinary teams. The big problem is no matter how hard you want to do it, the legacy is there. So it's very difficult to get it, to pass it through. So my first, fintech company was exactly, that's how we started, because this whole team knew that they couldn't accomplish that within the organization, but we could do it outside, and then we would become a vendor. And so that's one way. I've also working with, for example, Fidelity in their Center for Advanced Technology. They incubate and they do it internally. And then they, like one of their new blockchain company was spun out of a big project because that was a commitment, and they knew they needed to be in that space. So they wanted to first understand it, know, and then accomplish other tasks. So there's plenty of other reasons why. But there has to be that justification and that motivation. There's also, you're seeing a number of other financial firms sort of create these, incubate or accelerate on the side, and then they either try to bring it in, but more often than not, you're seeing them spin out. Like Doug brought up, the Marcus platform, which actually was a startup, then was bought by Goldman Sachs, and then now they just couldn't do it because it just never flowed within, the synergy wasn't there in the organization, and it was, maybe the timing was off, but but they could build it up, and then it's, sort of taking it on, on a side, on a different life as we speak. But I think that's the important, and then many organizations are just buying other, sort of startups that are incorporating. Remember, the one thing about startups though is, like Doug said, they catch up. The legacy organizations catch up, or they adapt, or they somehow bring those in, but they have that infrastructure, and they have the clients, and they have that legacy. So even though others are coming in and they're growing and it's all great, they'll move as well. So they're sort of coming from all different directions. But I think the important part that Mike brought up was, where do you want to be and how can you make an impact? In my mind, it's where can I solve a problem, and where can I make the most impact. So personally, you know, that's where I want to be. If you have all, you know, if you have a culture within a firm, some are much more motivated to be cutting edge, and some are just trying to keep up. And, you know, so if you're keeping up, maybe that's not necessarily, you know, the fintech, you're not going to feel like you're really driving the future as much as, you know, creating the infrastructure for today. But I think that's the important part, is where do you think you can do it, and does the firm fit with you, and you know, can you actually change people's lives doing that?
Thank you all so much. Oh, sorry, go ahead.
I was going to say, to Greta's point, though, there's always the choice. And I think that's the other thing to remember, is a lot of these legacy companies can choose to be innovative or choose not to be. So actually, Doug brought up Visa, and I actually know Visa very well, Doug. In a lot of cases, Visa waits until the product market fit has been defined by someone else. And then what they do is they go all in on it, because they don't have to spend the money failing at first. They find someone else who's done it. And MasterCard also does a great job of this by running those incubation and accelerator programs. And then they take what they see, they recreate it internally in their own countries and roll it out. And so I think there is choices that you get as a legacy firm that give you optionality that you don't necessarily get as a startup.
Excellent. Thank you all. I'm going to turn it over to Liam.
I also, echoing Paige, thank you guys for your time. So I work at Oracle, so I work in an industry that's seen an immense amount of consolidation over the last 10 years. And just curious to see your forecast for what's going to happen in the fintech world. We've seen a lot of companies start as point solutions, SoFi, for example, and then really grow their breadth, expand into insurance, expand into refinancing, credit cards, et cetera. Do you see fintech as being an industry that's going to have a lot of consolidation moving forward? Or are we going to see different point players kind of dominating their specific sector, their specific part of fintech?
That's a great question. I'll take a stab and probably be the shortest one. But I think when I was working in particular with TD Ameritrade, we kept talking about Amazon being our competitor, or the competitor, not me, because I was always on the outsider. But you know, so I think there's so much in terms of the competitive space is so different, and the market has changed so much, and the expectations and the opportunities and the technology, that fintech, I think it's just constantly evolving, and I think it will change increasingly. But I think what we think about as finance is not necessarily is going to change even more. So, you know, I think your typical platform, you know, your Apples and your Amazons and all of those are not what you think of as financial firms or financial technology, but those are those are the drivers more so than the actual infrastructure of a typical bank or financial investment firm or so on. So I think also in the investment space, so for example, I think there's a lot of investment in fintech. So if you think of the Bains and the so on that are actually investing in this space and actually transforming markets, that's where their interests are. So their fintech organization has grown tremendously, and the diversity of investments are things that you just never think of as being fintech. But as we said, it's so broad, but it's you know, moving money around or allowing people to transact. So I think that's the important part to keep in mind. So yes, I think it's going to transform completely in so many ways, but what to predict that is another story.
I'll add just a few thoughts. It's a good question. It's a tricky question because I don't think of fintech as an industry. Like Mike said earlier, you almost have to break it into the different industries and then ask that question for each one. So as it relates to banking or investments, they all have their own different industry structure, players, history, dynamics. And I won't attempt to do that across the different industries. But what I will say kind of more thematically, which is that, Mike made this point earlier, startups have a great opportunity to come in and try and solve a very specific point problem with tremendous focus and speed. And that gets, if it's a success, that gets a lot of traction. One of the challenges that a lot of startups have, especially within financial services, is their profit model and how they actually make money. So in order to grow, a lot of times the reinvention has to do with the removal of fees or the removal of costs or something in the existing kind of economics of that space that may not be sustainable over the long run, but can be a good way to get traction and drive growth in their initial product. So you see a lot of companies, SoFi comes in, reinvents the idea around refinancing student loans. That was their point focus. It was literally for Stanford alumni of Stanford Business School alumni only. That was the original product. And then it gets expanded out to other schools. And then it gets expanded out to other different loan categories. And then it gets expanded out into other financial services categories. And so I think that, over the long run, companies will wind up, sort of maturing and diversifying their kind of businesses into different markets. But, as Mike said earlier, technology is a big driver of sort of disaggregation, as companies try and go out and solve these problems. So that's a kind of wishy-washy answer at the end of the day. But basically, I think that because these industries are complex enough and big enough that there's plenty of room for companies to come in and be point solutions. But for the ones that sort of tend to succeed and become everlasting brands, they tend to become more diversified over time.
So I 100% agree with that. The only place I would push is I would actually separate the industries from a true B2B industry versus a B2C industry. And so I would say when it comes to B2B industries, the innovation is a lot harder and you see parity happen a lot quicker. So if we start thinking of merchant services, if we start thinking of trade services, if you start going down even documentation as a service, right? And so if you start going down that path, I think you do see consolidation usually happen a lot quicker. And consolidation will happen where the big eat the small, and then it becomes part of the flow. And I think it's trickier to create a differentiated user experience and user interface at that point when you're talking about true B2B, because it's all about the optimization and the cost savings. And that's really what you're looking for as a company. So I would argue that, and just to be controversial, I would actually say from a B2B perspective, you will see consolidation happen quicker than you would on the B2C side. On the B2C side, again, just echoing what Doug and Greta have already said, I think that's a longer curve. I think, again, you can come in, you can innovate on a solution or a problem. And in some ways, you don't even have to innovate that much. You can just create a better experience for figuring it out. Maybe it's 2 clicks instead of 4 clicks to actually access, and it's smoother and it looks nicer. And that in itself, and then your friends use it and you create network effects from it. And so I think it's a little bit easier to create that innovation, and people are willing to have more experiences across the board because you're not necessarily looking at pure optimization or pure cost savings. And at that point, you end up, as companies grow, they diversify and extend into new products. And consolidation becomes a lot harder at that point because new industries are getting looked at. So I would say you'll see it on the B2B side first before you see it on the B2C side.
Thank you. And I'm going to invite Henry to ask a question.
Hi, everybody. Thank you for coming out and talking to us. It's been very helpful so far. So I have a funny story. I was just home today in the living room, and I walk into my mom, having been on the phone with the mortgage lender for about 2 hours, and she's giving me this look like, save me, like, get me out of here. And when she hangs up, I mentioned, like, why not, like, maybe switch to like a new startup kind of mortgage lender? And she says, how can I trust that? And I was like, oh, I don't know. How can you trust that? So I feel like there's this kind of gap between the older generation and the fintechs and kind of that stability, because it's financial services is a very cost heavy industry. So how do you kind of bridge the gap between the two and like kind of create a sense of stability?
Yeah, I guess I'll jump in here. It's a great question. And because financial services, we're dealing with money, trust is such a huge component, whether that's a consumer business or even a commercial sort of provider business. I think that obviously there's user behavior differences between different segments, as you kind of alluded to it, sort of older versus younger generations, are part of that. The actual business itself is also somewhat a part of it. I know back from kind of my days, we used to talk about that. It's a lot easier to lend money sort of as a newer player than to, hold deposits as a newer player. Said in other words, consumers are much more willing to kind of borrow money from entities that they don't necessarily know as well as ones where they're going to put their savings. And I would extend that to investments as well. That said, you've got companies like Robinhood is obviously very much in the news these days, where they've been able to come up with a different a model that appeals to kind of the user preferences of a segment that's out there. But even with a lot of traction, the smallest thing can disrupt that trust if it doesn't have kind of that history of trust, like a Fidelity would kind of bring to the table, for example. Sometimes the kind of alignment, as we talked about earlier, between old school and new school can help. So a lot of the digital banks that have started up over the years, as Mike said, all of those deposits eventually are held at an actual bank. In order to be able to say that something is FDIC insured, which is sort of like the brand name that everyone kind of relates to for safety, it has to be actually held at a bank. So, whether you're, at Chime or whatever, at the end of the day, there's a tag somewhere that says, that it's actually held by a certain bank chartered institution. So those are ways you can try as a startup to bring some of that trust in using kind of the, some of that industry legacy kind of history to your advantage until you can get to the point where you can start to become more of a trusted brand where you have enough history. I'll leave it there and let others comment.
I think it's actually that I agree with everything Doug says, of course, but I think it's really interesting that that your mom said, I don't trust, how do I trust the new ones? Because there's such a legacy of being, so many bad things happening with big banks. I mean, take the Wells Fargos and there's just so much, and which was the opportunity in so many respects for for fintech to take off, and because it was not happening from insurtech to more lending in different ways. Yes, it goes through a bank, but the complexity and the networks there's so much interconnection. But I think that is actually one of the things that is the new technology driven organizations are much more streamlined. So there's not, and maybe that is what they bring to the table, but it's a matter for the marketplace and for them to convince the marketplace that that's that's the case, and so it's about all positioning, I guess, but it's also for the legacy banks and institutions, it's their business to lose because they do have the advantage, but they are, because they're so big and so not agile, things happen and they're so pervasive that there's tons of opportunity in that particular space.
I don't there's nothing really to add. I think Greta and Doug nailed it. The one thing I would say is I think trust is absolutely an asset to legacy companies, but I would argue trust, and we've looked at a lot of research on this from a banking perspective and the services that underlie a bank. So whether we're talking about loans or whether we're talking about credit cards or whether we're talking about payments and all that goes along with it. But I would argue that trust only goes to a certain age. And for millennials, and even Gen Zers today, it doesn't matter. So trust will be eroded over time in the sense that it's not going to be an asset come 15 years from now. Is everyone will be at a very similar playing field because it's all about the experience. And so even if you are JP Morgan and your loans have been around for 200 years with Chase and people trust you, if I can get that loan through Rocket Mortgage faster with less hassle and less time spent, I'm gonna, as long as it's at parity or the rates are similar in some way, and it could be all digitized and I never have to do a wet signature, up to a certain age, I'll pick Rocket Mortgage every time. And so I think hearing about your mom, I think that's a generational difference, which I think is a pro today for a lot of the legacy, but I think that asset is going to go away over time. And actually, the second thing I'll highlight here is digital trust, I think, is going to become a very hot topic, and I'm personally passionate about this within fintech. So the idea of digital trust and digital identity and how you can really prove who you are. And I think COVID has really pushed this to the forefront. And I think having a conversation on that could be very, very interesting on an off topic, because I think that'll play in a lot to the experience that'll come through mortgages and buying homes in the future.
Great. Thank you. I'm going to give Derek a chance to ask a question.
Looks like he typed it in chat.
Oh, got it. All right. Thank you all for sharing your insight here today. I just wanted to, have to get this going on my screen. Just wanted to ask if you would say it's better to specialize in studying fintech and that it would be a specialized role down the line, or if fintech would just be generally added to banking and finance people's repertoire.
I'll just give the quick answer here and go with the latter. Because again, fintech is just an innovation, and I think you're going to see disruptors in every industry, and you've already seen that. I would argue education is kind of the last big industry out there that really hasn't, quote unquote, been disrupted. But I would say, look, fintech is just a portion of banking and finance as a whole, and I think you really have to understand you have to understand the industry to understand how to innovate within it. And so that would be what I would say. Doug, I see you jumping in.
Yeah, I mean, I was just going to say this one's near and dear to my heart, but you nailed it. The program that I'm focused on right now, it really is grounding people in the fundamentals of the different industries that they're interested in pursuing and innovating within. And then, of course, understanding, the technical capabilities in order to figure out how to apply that in the most effective way. But you really have to get the business kind of as the foundation. So, there's a kind of a balance between the two. But yes, I think that fintech is just another way to say innovation within financial services. And so you need to understand financial services first.
I mean, I obviously agree completely. And, it was being in finance in my own case that, and working as, I was like Doug as a strategic, my background is strategy, but trying to solve problems within finance that created that opportunity. So it's about being in the place to see the problems or understand the problems and then create a solution and innovate solutions. And I think that's the most important thing. So where your passion lies, or if it's it's some other problem in the marketplace that a finance solution can create, then that's the path you probably want to take. But I think it's critical to really understand finance. And I mean, I wish I did it much earlier because I actually love